welcome to this week's episode of Coinscrum Markets. I'm Pierre Martinov. Coming up, Crypto Finance's Patrick Heusser returns to review the markets in Crypto RFQ. Paul is joined by Mike Colyer from Foundry to talk about how they are financing crypto mining and staking infrastructure. I talked to CryptoCompare's head of research, Constantine Tsavliris, about their latest crypto exchange report. And ByteTree's James Bennett is back to look at on-chain data and on-chain reaction. But first, a look at this week's blockchain industry news. With the dust still settling from the US elections, the UK's Chancellor Rishi Sunak published his post-Brexit financial services agenda this week. Highlighted as the main fintech topic, he specifically cited stablecoins and CBDCs while launching a public consultation to ensure that stablecoins meet the same standards as other methods of payment. US lending firm CRED filed for Chapter 11 bankruptcy protection this week, having already suspended customer deposits and withdrawals. In late October, the company announced that it's working with authorities to help investigate irregularities in the handling of corporate funds, citing a fraudulent incident as the cause. Bitcoin's recent success at converting previously skeptical investors continued this week when billionaire hedge fund manager Stanley Druckenmiller announced that he's now long Bitcoin, having previously dismissed it as a fraud. Already hedged against his predicted US dollar weakness with a large gold position, the seasoned investor believes his much smaller Bitcoin balance will outperform the yellow metal due to its attraction as a store of value for both millennials and West Coast money. And it seems Druckenmiller isn't alone. In a recent report, US investment bank JP Morgan noted that Grayscale's Bitcoin Trust saw a much greater rate of growth in October versus gold ETFs, where inflows have flatlined, commenting that institutional investors such as family offices now see Bitcoin as an alternative safe haven asset. And finally, Ethereum's much anticipated migration from a proof of work to proof of stake consensus algorithm got off to a relatively slow start over the past week. Only 50,000 Ethereum have so far been sent to the deposit address that will be used to signal the activation of the new network on the 1st of December, but only if that number has reached 500,000. With so much Ethereum still locked up across DeFi, it seems like DeFi degens are a tough crowd to attract. That's the news for this week. Make sure you remember to subscribe to our channel.
Thank you, Pierre. I'm very pleased to welcome back Patrick Heusser from Crypto Finance, Head of Trading over there. Thanks for coming back. It's been a while, Patrick. How are you doing?
It's a pleasure to be here. Thanks for inviting me.
Good to see you. Good to see you. So look, let's dive in. I know you've got a couple of charts that you want to look at. Just looking at recent market activity, first in Bitcoin, and then maybe we'll touch on some DeFi movement as well. What are you seeing in the Bitcoin market?
Well, if you look at the big picture chart, then you can see very clearly that the market had a very bullish tone over the past several months, and we had a very nice breakout out of the recent highs, out of the clouds, and it was also accompanied with good volume. So it all looks like a proper bull market.
Yeah, and what do you think the critical levels are on the downside that people need to watch?
Well, first is 14,000. I see a bit of a wide range, 16,000, 14,000 for the consolidation right now. It can actually go through even towards like 11.2 sort of, but I don't really believe we're gonna dip down there anymore.
Sure, okay, but all traders should have their stop losses in place just in case.
Yeah.
Like sharp weekend movements, we saw one of them last weekend. And what about DeFi? That suffered after its kind of big run up during the summer and had a big pullback, but it seems to have turned around a bit. What are you seeing there?
Absolutely. We saw a lot of suffering, even though the suffering was sort of short-lived, but it was very painful, very quick, which is quite normal in these kind of small cap tokens. But the rebound was astonishing, especially in the bigger DeFi tokens. We call them blue chip DeFi tokens, and they have some more juice to go. With let's put it that way, if Ether doesn't let us down, then they really have some more power to the upside.
Sure. Okay. I mean, we'll come on to it a bit later because we're going to talk a little bit more about DeFi and I guess, as you say, the whole kind of Ethereum migration, which has kind of kicked off recently to move to proof of stake. So we'll come on to that. I know another area that you guys look at closely is across the CBDC market, central bank digital currencies. Seems to be moving apace. I know the the Treasury, Rishi Sunak came out, the Chancellor in the UK came out this week and set down some proposals for putting some guidelines in there. What are you seeing across that space?
Well, it's the usual thing, right? Asia is marching ahead. I mean, especially China and the smaller countries, they're quite far or advanced in their projects. I mean, you wouldn't even call them projects anymore. I mean, Cambodia went live with a CBDC solution, and they have already some commercial banks attached to it. Thailand, Hong Kong, they have some sort of a payment gateway between each other, also on purely digital. And then obviously China with their CBDC or E1, they call it, which is very advanced and already working in a few areas or states or provinces. We see then obviously Europe with a far bigger issue with so many countries and so many different opinions and politicians, only in a project phase right now. They say they're going to come together in June 2021 to discuss all the different opinions. And I mean, if you ask 20 politicians what they want or need, you get 40 different answers. I'm not quite sure how quick Europe will get to a proper CBDC project. The UK, obviously, in a different situation right now, just need to look out for themselves. But obviously, they need to make sure that they stay connected to their trading partners, which I believe the CBDC is going to be the key every country needs to be able to settle their goods and their money. And I think as well, the CBDC push gave the stablecoin market another positive spin, because everyone knows that the nations or governments, they're working slow or slower, but the stablecoins are already here. They're already working. We have several billions in those stablecoins already parked and moving around the globe. So I believe that corporates will fairly soon look for stablecoins to move around funds, intercompany-wise, but across the globe. It's going to be a cheap and fast solution for them. And as soon as they have the infrastructure in place in their companies, this is going to be a solution they're going to use.
The other big story of the last few months, which everyone's kind of assuming has given like Bitcoin in particular a big uplift, is some of the news of kind of high profile investors entering the market, and also corporate treasury being allocated. Obviously, the biggest one was MicroStrategy, and then followed by Square. What's your thoughts on that space?
At least it gives me some answers, because I was watching the as a trader, I watch a lot of charts and especially order book graphics, and the move up in Bitcoin over the past 2 months was not driven by derivatives. It was not driven by any leveraged guys out there. It was not driven by liquidations, and it was not driven by large bid side orders in the books. I just saw the price moving. I just saw people coming in, buying at market and lifting the offer, and the offers got thinner and thinner. And I was like, well, how can this be? I mean, we just eating through 5,000 Bitcoins on the Bitfinex order book like there's nothing. And all these news now on the back of it, they make total sense to me. So they're just buying constantly. They're obviously just, they're not buying big clips, but they buy constantly. And that's exactly what we have seen in the market.
Sure. And I think the other dynamic which I noticed was at the same time, and I guess that kind of supports that kind of thesis, is a lot of Bitcoins are being withdrawn from exchanges now. So they're being moved to cold storage, which would make sense that what was inventory for traders sitting on exchanges to trade with is now being bought for long-term holdings. And I guess that could have, more liquidity implications going forward. I mean, you said you've seen trades eat through order books like, a knife through butter. And we're just, if there's less liquidity on the exchanges, then, we could see a lot more of these kind of sharp moves upwards if that trend continues.
Correct. This is also something I'm watching on-chain analysis. As you just mentioned correctly, the balances on Bitcoins on exchanges rapidly decreased. And I talk about it and I label it as a sell-side liquidity crisis, which seems to, I think we're in the middle of it, actually. And if I'm not seeing on-chain movements of large amount of coins going back to the exchanges, I just believe that the price can only go up, because there is just nothing that can stop the buying pressure we see at the moment.
Sure. Actually, I think that leads us in quite nicely to kind of just the final part that we're going to talk about. We mentioned we'd come back to DeFi and also how that ties into the ongoing migration or potential migration to EP028. A week ago, Ethereum opened up their deposit contract, which is designed to allow existing ETH version 1 holders to deposit their ETH into that contract. And when it reaches a critical threshold, which I believe we're still some way short of, then that will effectively trigger the launch of the new network. And I guess it feeds back into that same question about future liquidity crises, that if you've got a network which is actively encouraging or requiring people to lock up funds on the network, then that affects A, liquidity on the exchanges, and B, with the DeFi movement, you could argue that funds aren't being deposited because people are seeing that they've got more potential opportunities in kind of yield farming. Plus, you have to, as I understand it, lock your ETH version 1 up into the contract for 2 years. What's that going to mean? And in general, your other thoughts on DeFi at the moment? Yeah,
well, in general, as you also pointed out correctly, there is quite a bit of BTCs wrapped up in the DeFi space. So this is also taking liquidity away from BTC. And then, as you also said correctly, the whole DeFi sector works with coins being locked up in certain vaults or in staking contracts, which takes out liquidity of the market just by concept. But what I think, or where I see there is a lot of potential in the DeFi sector, is building these products which are they're no new inventions. They're products we know from the traditional markets. Let's start with normal money market borrowing and lending protocols. But the way they're done and the way you can interact with them directly as a trader, investor, or retail guy is just amazing. And it will eat away a lot of trading and margin of the commercial banks when users start to move away and say, well, I have my salary account with the bank, but you know what, I use a lot of my savings in different areas, and I will pledge them into some yield farming projects or into some staking contracts, or even just move them to a deposit platform and earn some interest, because I think no one earns interest at the moment outside.
Yeah, exactly. And just back to the stablecoin piece. I mean, you're looking at some of the yields there versus what you can get with your cash in the bank at the moment, and that's surely going to start appealing to traditional money managers, that if they can, obviously, interest rates are basically your measure of risk, so it's not risk free. But surely there's going to be some more interest and demand there as well, coming in from the traditional space. Patrick, excellent stuff. Interesting as always. Great to have you back, and we'll have you back again on the show very soon. Thanks for joining us.
Thanks a lot.
Bitcoin and Ethereum's proof of work mining infrastructure reached industrial scale some time ago. But with new generation hardware for Bitcoin mining hitting the market and Ethereum's imminent move to proof of stake, there's been a growing demand for capital to finance growth. With this in mind, Digital Currency Group established a division called Foundry last year to help meet this demand. Paul spoke to their CEO, Mike Colyer, this week to find out more about this nascent part of the industry.
Thank you, Pierre. It gives me great pleasure to welcome Mike Colyer, CEO at Foundry. Thanks for joining us, Mike.
Yeah, absolutely, Paul. Glad to be here.
Great. So Foundry is actually established recently, or about a year ago, and it's under the DCG, Digital Currency Group banner. Just for our viewers that might not be familiar or so familiar with Bitcoin and Ethereum mining, probably heard about it, but don't necessarily understand the mechanics. It's grown out of literally people's bedrooms 8 or 9 years ago into a multi-billion-dollar industrial business that's in some people's eyes is consuming too much energy. The actual demand that network kind of creates in terms of that energy cost is really a direct function of the price of Bitcoin or Ethereum. The higher the price goes up, then more profitable miners can become. Then that kind of attracts more miners into the network, and those guys need to finance hardware. So, Foundry was established with this in mind, looking at the infrastructure, and not only on Bitcoin mining and proof of work mining, but with Ethereum moving over to proof of stake in the near future, there's a whole load more infrastructure to support there. And DCG as a company has a whole bunch of portfolio companies and clients that probably have an interest in this area. So with that in mind, Mike, can you just kind of give us a little preview on why DCG set up the company and you joined as their CEO, and what opportunities you're spotting?
Yeah, sure. It's great to be here and excited to talk to your audience and share kind of our vision of where the future's going. So I've been in the mining space for about 3 years. I spent 20 plus years of my career in kind of what I call the old world: manufacturing, distribution. I was a hired gun in the private equity space, and about 3 years ago jumped into the crypto markets and fell in love with the mining aspect of it, because I really felt like we had to build out the infrastructure before this could really scale. Mm-hmm. And it reminded me of the start of the internet back in the early 90s. I was in college when like Netscape came out, and it was just felt like this solves a lot of stuff that couldn't be solved with the current technology. So I kind of dove into the mining part of the world, and about a year ago, a little over a year ago, I got a call from Barry asking to come on board to run their new business called Foundry. And DCG had avoided the mining space really for the last 6-7 years. It was really kind of the wild, wild west, and it just seemed like a tough place to do business. And then about a year and a half ago, Barry went to buy some machines to mine an algorithm and realized that it was still, the wild, wild west. And it was one of these moments where he said, you know what, it's time is such an important part of the overall ecosystem that it was time for DCG to get involved. And it's been great. It's been, a wild 12 months. He basically gave me a white sheet of paper and said, all right, figure out where we can leverage the DCG balance sheet, its brand, its portfolio companies, and where can we add the most value in the mining ecosystem. And we're really focused on proof of work and proof of stake. And, we firmly believe that more institutional players are going to be coming to this space. They're going to start recognizing the opportunity. And we wanted to help provide solutions to make that transition happen even faster. And we're looking at really, how do we grow hash rate in North America to continue to decentralize this Bitcoin network throughout the world?
Yeah, absolutely. Thank you for that. I mean, I recall at our early Coinscrum events back in 2013, we used to give the audience a demo of how to build a home miner using a milk crate and a GPU. And it's changed a lot, I guess, since then. So
yeah, so and it's amazing how fast the field evolves, right? So when I started in the middle of 2017, we grew like a mining facility from 1 megawatt to 3 megawatts, which seemed like this enormous project at the time. And now we're looking at sites that literally have 100 megawatts worth of machines on them. And that's what people are planning for going forward. And it's amazing. It's amazing.
Yeah, no, absolutely. And I think to that point, 100 megawatts, I don't know if anyone's seen, a facility of that size, but, I visited a couple and, or getting toward, not even that size, but, maybe a third of that size. And it's kind of, it's some serious infrastructure that needs to be built out. If you're going to have more 100 megawatt facilities, that's a huge amount of capital that's required to fill that. And as I mentioned earlier, if the price of Bitcoin keeps going up, that's just going to be pulling in a demand for more capital because the profit incentive is going to be there. So maybe we can touch on, like, as you've entered into this market over the last year, I assume there's definitely demand. The miners will definitely want to kind of finance their infrastructure on debt. So can you kind of give a profile of the typical client that you're speaking to, the jurisdictions, and what you feel the size of the addressable market currently is?
Yeah, so a couple items. When we looked at this blank sheet of paper and said, where can we add value? We wanted to bring more hash rate into North America. And, all the machines are manufactured in China. It's difficult to get to the front of the line to get the latest and greatest. So we decided that we could provide, we wanted to help miners in North America, right? So what we want to do is provide the capital to them so they could get to the front of the line first to get the machines so they can grow their hash rate, right? So we're going through this technology shift, right? The newest miners are out. They're much more efficient than the old miners, and everyone has to upgrade. And so when we started looking at it, we said, hey, well, let's build a business around equipment financing and using the equipment as collateral, which has been a huge success. We also mine ourselves. So we have our own fleet of machines. We don't have our own facilities today. What we do is we partner with, trusted host providers throughout North America, where we can develop a relationship and we've got skin in the game, right? So as we work with other people that want equipment financing, we say, look, we're using the same machines. We understand the market dynamics. We understand, the risks here. We're participating with you in this process. And then we provide advisory services to folks. So as more institutional money, as people like to say, come into the space, we can help them navigate the pitfalls of mining, right? Like you only have to make a couple of mistakes to lose your investment. Mm-hmm. But if you get many of the key points correct, it's a great business.
Sure.
Go ahead.
No, so I was just going to come back to that. I mean, so you're focusing on North America and, again, back to the Wild West point earlier, how have you seen the market change? And, if you're lending money, even if it's secured against their hardware, if you're lending money to people, then, your kind of due diligence process needs to be good. And how have you seen that changed? And what are your criteria if you're going to be engaging with people?
Yeah, so it's a great point. And so for us, we're very careful on who the end miner is, right? So we want to work with folks that understand the risk of the space, that have some experience in it. We're also very particular in terms of where the machines are located, because the installation of those machines, the timely installation of those machines, as well as keeping them up and running is critical, and the underlying cost for running them. And then we only work with particular machines. So we're only doing new generation machines. We've right now been focused on Bitmain and MicroBT because they've got the best equipment available out there. So we're very selective in terms of who we're willing to work with. And we typically, have a lower limit of about $1 million. So we're not doing smaller deals. And then, in terms of how big we'll go, we'll go as big as, the credit of the counterparty will allow us to go.
Sure.
So these are big projects. They require a lot of capital. But we've got very strong relationships with MicroBT and Bitmain. We've worked really close with them to secure supply of machines. I think that's probably the biggest thing that's different today versus maybe the last cycle is there's a limit on the wafer production today.
Yeah.
Which is changing the dynamics a little bit. And I think will change the dynamics at least for the next 6 months, where Samsung and TSMC just are not giving the same allocation as they have in the past. So for the best performing machines, there's a limited supply and it's really hard to get your hands on them.
Yeah, I saw a note that there's a 6-month wait, or if you don't have your orders in, you're not getting anything before April next year now.
Yeah, that's exactly it. Both MicroBT and Bitmain for their best units are pretty much sold out through April. And look at the last time I checked, Bitcoin price continues to go up. So yeah, there's even more and more demand. And this is part of what makes the industry difficult is you have to place your bet 6 months ahead of time. You have to put your money down 6 months ahead of time. And there's a lot of risk with that, right? You hope that the equipment manufacturers will honor your order. You hope that they ship on time, and then you hope that they get installed on time. And I think that's one of the different things right now in the cycle is there's actually been a lot of capacity built out in North America over the last 3 years. So we were kind of late to the game, I would say, in terms of building out large scale mining facilities. But 2018, 2019, and 2020, there's been a lot of construction built. So there's a lot of space available for equipment, and now there isn't a lot of equipment out there.
Well, I guess, people try and kind of use analogies against, commodities mining, physical commodities mining anyway. And I guess, from the miner's perspective, yes, there's a time to go and buy new hardware, especially if it's new generation and you're going to get kind of major improvement in efficiencies and mine more Bitcoin. But I guess there's time, and only time, I guess, will factor or learn this over time, that there's times to step back and just invest in actually building the infrastructure, because the other, you might have a wait time on getting your delivery of new hardware, but also if you want to go and build a 100 megawatt facility, that doesn't happen overnight. You've got, 6 or 9 months or whatever, at a very minimum, if you're prepared to go and build that out.
Yeah, I think one of the key things is absolutely understanding the cycle of the mining industry, and it goes through a cycle, just like any commodities type mining goes through cycles. I think our cycle is much faster than the other cycles, so you have to be you have to be quick. And just like commodities, I think a lot of times you have to bet counter-cyclical too. So in January of this year, when all the online mining calculators said it was not a good time to buy machines, we placed enormous bets on procuring equipment, and that equipment wasn't going to arrive until May. But we bought a lot of machines. I mean, we have deployed over $100 million into North American mining ecosystem.
Wow.
And we had the latest generation of machines plugged in May, and we've been mining with them since May, and those machines are worth more today than they were when we bought them.
Yeah.
So I don't know how people don't think mining is a good investment. It's been a great investment, and it's going to continue to be a great investment for the next 18 to 24 months.
So just back to, just interested in terms of, you're financing firms into the tune of $100 million so far. And then you mentioned your relationship and your orders you've made directly with the manufacturers. How are these loans structured? Are you kind of bringing them onto your balance sheet and then leasing them out, or are you actually directly lending to companies and to manage the relationships?
Yeah, so today our equipment financing, we use the equipment as the collateral. We require the customers to put some skin in the game, so typically 20% down. We'll finance equipment for 12 to 18 months. And the idea is, hey, get the equipment, get it plugged in, and let the equipment pay for itself. And that's been our strategy from the very beginning, and I think it's been very miner friendly, right? We're miners, we understand it, we understand how the system works, and we're trying to create products that work well for miners.
One thing I've thought about, because I mentioned much earlier in the conversation that up until now, early miners kind of who kept hold of their Bitcoins, some of them didn't, and they failed early on, and the right strategy was to hold the Bitcoins. Maybe that was right then, and it's not so right now. But those companies or firms that have survived managed to kind of fund their future expansions on retained earnings, or maybe having to, as I said, raise some capital, giving away equity in their company. Do you think that financing, because obviously there's probably some other firms that are looking at this as well and getting into the market, because there's going to be probably enough demand for everyone or a few people to come in and service these needs. Do you think there's a risk around effectively, if you're offering up financing on hardware, no miner is going to say no if they can basically get into the market quicker. Do you think there's any risks around kind of, front loading the hash rate into the market, if you like, if other people are borrowing all around, and then all of a sudden more hardware is coming online than can maintain profitability for everyone, because if everyone comes online, then, with the dynamics and economics of Bitcoin mining, everyone's profits will get squeezed. Do you see that as a risk?
I think because this market goes through these cycles, there will definitely be points in time where it'll be overheated, and that's exactly what we'll see, right? We kind of went through that in, the end of 2017, early 18. That dynamic was a little different because the manufacturers were delayed in shipping their hardware. There was a delay because there was no place to plug in the hardware, so a lot of people waited. So you kind of saw like hash rate grow a lot after Bitcoin price was coming down, because the orders had been placed 6 months prior. In today's market right now, the limiting factor is really the wafer production, as far as we can see. So there just isn't, I agree with your premise. If there was unlimited amounts of machines and then we had this debt financing available, we would see hash rate growing at a much, much faster rate. Today, you just can't buy the machines. So maybe 2 years from now, that will be the case when they've got a bigger wafer allocation and there's more machines available. Can debt financing kind of overheat it? Absolutely. But today, it's a great way to secure equipment and grow your mining facility faster.
Sure. Cool. Well, I think we could talk about proof of work
all
mining
day.
All day. We could, but look, another area that you're looking at, and we've seen a few networks come online in the last couple of years that are have started experimenting with the idea of proof of stake, which is far more energy efficient. Open debate about the long run, and that's got to prove itself in the wild in terms of security, but things have been working so far. So in terms of what you're looking at in the staking side of the market, what's your plans there, and what are you doing for people that are looking for exposure there?
Yeah, so in the last 12 months, we've built, we continue to build out our team, right? So I think we're up to about 14 people now. So we've been growing pretty quickly. Part of the team's focused on proof of work. The other part's focused on proof of stake. To be honest, that wasn't a big, strong suit of mine. Like I'd spent most of my 3 years on the proof of work side. So the last 12 months, I've been like reading and soaking up as much as I can on the proof of stake. And so a couple takeaways from that. One is a lot of these projects have been around for a while, right? They were announced back in 2017. And what I don't think people realize is for the last 3 years, even though we went through like crypto winter, these teams have been building and they're all getting ready to launch now their networks, which is really exciting. And I don't think a lot of people appreciate how much work has been done around some of these. And we just saw like Filecoin go live finally. There's lots of those examples, and kind of our job is to be the infrastructure provider for DCG portfolio companies. So we're, and by the way, other institutional investors that want to get involved in proof of stake, they're not going to want to do the hard work of learning how to do the actual staking and the infrastructure of that. So that's what we're doing. We're building out that expertise. We're building out that infrastructure so we can provide those services to others. And there's a lot to learn. It's still, I don't know, maybe it's like Bitcoin mining in 2012, you know, like it's still very early stages.
Yep, I'm sure we're probably
but it's here to stay. It's not going away.
Absolutely. But I mean, again, as a company, as Digital Currency Group, you know, you again, within that portfolio, you've got Grayscale, you've got Genesis. These guys are dealing directly with institutional investors. And in the current environment around the world, of pretty much zero, if you're lucky, if it's zero interest rates, if they've not gone negative, then, you know, I mean, if we leave maybe DeFi aside for now, but just the idea that the staking is kind of a yield generating instrument, you know, what are you seeing in conversations with that type of client? Are they like, well, you know, if I can go and earn 6-7% by staking Ethereum, if I hedge my Ethereum position properly, I mean, that's a great yield compared to anything else I get. Do you see, you know, is interest building around that, or people understanding that?
People are just starting to understand Bitcoin and the rest of the world, right? Like sometimes I feel like I'm in this like echo chamber of the crypto Twitter verse, right? Where we're all so familiar with what's happening, and the rest of the world, like my neighbors still don't understand it. You know, they, so we are at the very early stages, but it's happening fast. And I agree with you. People are going to be looking for yield, and there's some really good solutions out there to get some yield. By the way, we didn't talk about this earlier, but I think Bitcoin mining is essentially a yield product, and I view it as like a utility. Like if you're getting into Bitcoin mining, think you're going to get rich, you should just go buy Bitcoin. It's way easier. But I do think if you manage it properly, it becomes you kind of get a dividend from the mining on a regular basis. And I think there's going to be other options with proof of stake to do the same thing.
Completely. I think exactly that. It's infrastructure at the end of the day. I've kind of used that analogy over the years. You know, that's how, you know, look, volatility, and people that say, well, these things are too volatile, you know, as these things become more prevalent and more widely adopted, then volatility will decrease. It won't disappear completely. But absolutely, if these networks become essential for commerce in our everyday lives, then they're pipes at the end of the day. You know, someone had to go and build pipes to you know, so we got water in our homes, and build kind of, you know, electricity grids. So we got electricity pipes into our home. If you know, if the monetary function and that service is essential to everyone and commerce in general, then, you know, exactly, that's what it is. It's a utility function. So yeah, it's going to be interesting to see how that plays out. Mike, look, it's been an absolute pleasure talking to you today. I could carry on for a lot longer, but what would be good is that we can just invite you back for some updates further down the line. It'd be lovely to have you back on the show. Thanks for
absolutely. Thanks for the invite, Paul. It's been great.
Thanks, Mike. Back to you, Pierre.
Without the regulations designed to mitigate such risks in traditional markets, there have often been question marks over the integrity of the data published by certain crypto exchanges. In an attempt to help clean up the market, leading data provider CryptoCompare publishes a monthly exchange report, to help benchmark standards across the industry. I spoke to their head of research, Constantine Tsavliris, to discover their latest insights. Thanks. I'm Pierre Martinov, and I'm very pleased to welcome Constantine Tsavliris, head of research at CryptoCompare, to review their latest exchange review. Good to have you here, Constantine.
Thank you for having me.
It's a pleasure. Constantine, your team has been publishing a monthly exchange review for the last couple of years or so. Can you start by telling us how and why the report came about and why you saw the need for it?
Yeah, so 2 years ago, there was no reliable and consistent source of market intelligence centered upon exchanges. And this monthly report filled an obvious gap for that. The report aims to capture some of the key developments within the cryptocurrency exchange market. And it does so by focusing on analyses that relate to volume. So what we do is we'll separate spot versus derivatives, high risk exchanges versus low risk exchanges, and things like that. And we also provide an overview of some of the latest exchange news that occurred over the month. So users are free to click on the links provided if that's of interest to them. So it provides a good all-round overview of where the market's gone and where it's been as well.
So let's talk a little bit about the methodology and the benchmarks you guys use for this report. Can you give us a little bit more color on that?
Yeah, so the benchmark was created mid-2018 in response to a lot of the news about fake volume that was going on exchanges. There were several reports that tried to distinguish fake volume from legitimate volume. Our approach was that we would try to separate the lower risk exchanges and the higher risk exchanges based on a transparent methodology. It's a rigorous methodology that kind of looks at various categories of analysis. So we'll have a regulatory standing category, we'll have a data provision category, one looking at security. We look at KYC transaction monitoring. We'll also look at negative events if those have occurred. And finally, we look at market quality. We use a combination of trade and order book data to measure that for some of the exchange's major markets. It aims to look at things like liquidity, spread, depth, and similar metrics. And we take all of these categories and we assign scores to them to come up with a kind of a rigorous final score from, AA being the best and F being the worst.
Interesting. So a set of very granular metrics is there. Very interesting. All right. So looking at the regular standing, some regions have specific licensing and registration requirements, whilst others don't. So if an exchange operates in a region that doesn't have specific regulation for crypto exchanges, do you take the standard of their operational processes into consideration anyway?
Yes, we do. For many jurisdictions that do require a license, there are certain requirements under that. So a few of these might include trade monitoring, transaction monitoring, or more stringent KYC processes. And that's something we measure in the benchmark. So we do include that.
Interesting. Then how many venues are voluntarily implementing such as market surveillance tools, for example?
Based on the latest benchmark, our figures stand at around 50% of exchanges implementing internal market surveillance procedures. So they'll have their internal methodology to flag strange trades. But we also take into account exchanges that use an external service provider. So at the moment, we have the figures at around 5 or 6%. We actually award more points to exchanges that have an external market provider. market surveillance provider, because we feel that it's there's less conflict of interest to adjust any of the findings.
Oh yeah, that makes definitely sense. Okay, let's have a look at your presentation or at the report in greater detail. What were exchange traded volumes like for October?
In October overall, we actually saw an almost 18% decrease in volumes. And that goes for both top tier exchanges and lower tier exchanges.
Then we saw quite a pickup in volatility in the second half of October, something that would typically equate to higher volumes, but the numbers are down on the spot markets, at least from September. What do you think that might be?
Yeah, it might seem like a bit of a paradox, given that we've seen quite a significant bull run for the most of October. But if we look at September, in fact, we did see quite a lot of volatility when the price dropped from 12K to 10K. In fact, in general, there was more volatility in September than October. So that's one reason for the drop in volumes. Another reason is we've seen very little price reversal throughout the month of October, which means, again, fewer trading volumes throughout the month. More price reversal means more volatility, which means more trading. And finally, another reason might be that we've seen a decrease in interest in DeFi from September to October. Some tokens, for example, Yearn Finance, have dropped in value from 45K mid-September to 15K mid-September. So that's quite a significant drop. And it might explain, again, some of the drop in volume.
I remember that was quite painful because everyone was hoping it might go up a little further. How are things compared on the derivatives markets versus spot markets in terms of volumes?
This month, spot market volumes did decline almost 18%, but so did derivatives volumes. They declined to a lesser extent by 2.4% this particular month. That means that now derivatives volume actually accounts for around 52% of total market volume, whereas in the previous month, we saw that derivatives accounted for around 48%. And, if you look at a year ago, derivatives accounted for, just under 40% of total volumes. So then they've been making some ground.
So how could you, from your perspective, explain that quite significant increase in derivatives volume compared to last year?
Well, it can be, a couple different things. The first is new markets, new players entering the market. So one obvious example is Binance. A year ago, they accounted for very little volume. Now they are the leading exchange, followed by, Huobi and OKX. Another reason is that there's more variety in the types of products that are available. So you have futures, swaps, and options available on several exchanges now. That wasn't the case a year ago, and that also covers the underlying cryptocurrencies that were used for certain products. So maybe a year ago you might have ETH and BTC. Now you have many more of the top cryptocurrencies being used in derivatives products.
Interesting. Yeah, there's more diversification among derivative products.
That's for sure.
When we look at the profile of traders, what shift have you seen in terms of profile and sophistication among investors over the past year or so?
Yeah, again, it's difficult to pinpoint an exact change, but if we could, we know that derivatives products tend to be used by more sophisticated traders to hedge risks. given that derivatives volumes have increased, and that also goes for, options volume has increased quite significantly, especially on venues such as Deribit, we could then assume that actually there are more sophisticated traders operating in derivatives markets now than there was a year ago.
Interesting change, how quickly the markets change. Let's go to the next slide and let's take a closer look at the derivatives component of your research. Which futures exchange are included in the research from the first perspective?
Yeah, so we include all of the major exchanges in our derivatives research. So that includes Binance, Huobi, OKX, BitMEX, other players such as CME, Deribit, FTX as well. And they account for the majority of the volume. So we capture what the market is actually doing from month to month.
When we're now looking at the derivative products, options contracts are becoming increasingly utilized on both regulated and unregulated exchanges. What are you noticing specifically about them?
So specifically, options volume is increasing, especially on venues such as Deribit. CME volumes have been pretty steady in terms of their options volume. I think they peaked in June, so around 8,000 contracts were traded. Now it's sitting at around 4,000 contracts. We're definitely seeing increased open interest for options products. So it's increasingly being used as a tool for more sophisticated traders.
Okay, let's have a look at the next slide. How's open interest looking?
Yeah, I mean, at the moment, OKX is leading in terms of open interest at around $1.5 billion, closely followed by Binance and then Huobi. At the moment, CME and BitMEX are pretty much equal in terms of open interest, with just over 800 million, which is significant given that CME is, one of the only regulated players at the moment.
We've had a wild few weeks with Bitcoin price action and the US elections. What impact have the US elections had on the futures market? What's its volumes versus open interest?
It's hard to say exactly. We can see that volumes did drop from September to October for derivatives volumes, at least. And that's also the case from August to September. So again, difficult to pinpoint to point to the US elections in this case. There are, of course, other factors going on, such as COVID, the lockdown. Again, we'll see exactly how markets react to the ongoing US election situation in the upcoming months.
Let's have a look at your next slide and let's look more closely at CME activity. What are we seeing there at the moment?
At the moment, CME volumes have actually decreased in October. Again, in line with a few of the other derivatives exchanges. However, what we did see was that their open interest figures increased by just under 29%. And this might point to increased institutional interest in regulated venues. Again, we'll see if that trend continues into the future months.
Very interesting. I hope to hear more about that trend with you in a month. Constantine, many thanks for joining us and sharing your insights. We look forward to having you back on very soon again.
Hello and welcome back to On-Chain Reaction. I'm your host, James Bennett, and I'm the CEO of ByteTree. We provide on-chain data for digital asset investors to navigate the crypto ecosystem. Okay, so let's jump into it by looking at the on-chain transaction value that we've seen on Bitcoin over the last few days. We've actually peaked above $5 billion settled per day as price surges through the $15,000 mark and up towards $16,000 at time of recording on the 11th of November. Now we can see that typically, this only happens during bull markets. So earlier this year in January, prior to the liquidity crunch we saw in March, transaction value there was above $5 billion, highlighted in that gold circle. And prior to that, the only time we saw it was around that late 17 bull run, and we all know what was happening at that time. So it's very exciting for Bitcoin at the moment. Not only is the price surging, but we're also seeing a pickup in on-chain activity. Okay, so now moving on to our next chart. Here we can see the difficulty rate. Last time I spoke to you a couple of weeks ago, the difficulty was at an all-time high, which means that there was the highest amount of hash power dedicated to the network in Bitcoin's history ever. And we were anticipating that because block times had been slowing down, which is indicated by this blue line here on the far right side, you can see that block times got up to about 12 minutes per block on a 14-day moving average. And that led to one of the largest difficulty adjustments in Bitcoin's history. So actually the second largest, a drop of about 18%. And we think largely this was caused by seasonal adjustments. A large proportion of the network is mined in China, and as the wet season arrives, the miners move out, they pack up their old rigs, send them abroad, and of course stop allocating that power to the network. So we can see that the block times have responded very quickly to that and are now coming down. You can see it's 14-day moving average, but over the last couple of days, we're seeing blocks coming out a lot quicker than 10 minutes, sometimes towards 8 minutes per block. Okay, so as we know by now, this impacts miner revenue. So surprisingly, miner revenue has actually remained or reached and held above $15 million per day over the last few days, which is pretty impressive considering that block times had reduced, so the number of new blocks coming through was lower, and really that was on account of the rising fees offsetting that reduction in block reward. Fees peaked at about 22% of total miner revenues and are now starting to turn back down, slightly more sort of normal level, if you like, but normal within this new epoch where we have half as many bitcoins being rewarded. Of course, we went from 12.5 to 6.25 bitcoins as a Coinbase reward in May, and fees have stepped up to offset that revenue. So, here what I'm showing, the horizontal line is indicating where $15 million per day is, and the dark blue bars, indicate the revenue for that day. And you can see that up until the last few days, revenues had generally dropped after the halving, but now are holding relatively steady. And again, even above levels that we were seeing in late 18 when we were in the bear market, of course with a higher block reward, but less interest in the network and less fees. So overall, mining ecosystem is looking healthy. So if we dive in now to miners' inventories, at ByteTree this is one of our favorite indicators to look at. And we can see that miners have been depleting their inventories at a very high rate, not seen since the 2017 bull market. So our working thesis, as you may well know by now, is that miners sell into a strong bid in the market. So when they think the price will hold up and they think it's a good opportunity to sell, then we tend to see them shifting large parts of their inventory, and that's exactly what's happening now. So if we look at what this means for inventories more broadly, on this last slide here, we're looking at the rate of change in inventories. So inventory this year compared to last year on a rolling sort of 12-month window, and as a percentage of the total inventory available. And you can see the sort of 0% level there. So if inventories are changing 0%, it means that, you know, all the new coins being generated are continuing to be held. Are being sold. So, you know, for every new coin generated, it's then moved into the market. So inventories remain net zero, but that's not, you know, the trend that we typically see, because miners, of course, have their own behavioral preferences. And what we can see is that the rate of change of that inventory level has an inflection point at the beginning of bull markets. So if you look towards 2014, 2015, you can see when the rate of change started trending down. So that means inventories are being offloaded at a faster rate than they were before. That's when we moved into that bull market of late 16 all the way through 17, and then that inflection point at the end of 17, which marked the beginning of the bear market that was coming. And then you can see again, sort of in the towards the middle to end of 2018, we had that inflection point, which was, you know, the capitulation in December 19, which then saw you know, the beginning of the next sort of short-term bull market that lasted up until the middle of 2019. And you can see there again the inflection point when we start to move back up there through the slightly weaker period from mid-19 last year until January of 2020. And of course now we're starting to see the beginning of the next bull market, which is the current one we're in. So miners are an excellent source of information on the market, and you can find out more about that at bytetree.com. That's all for me for now. Have a great week, and I'll see you next time.
You've been watching Coinscrum Markets. Thanks for joining us. See you again next week.